Hi, I'm Tom Lydon here in Hollywood, Florida at the Inside ETF conference with Sean O'Hara, who's president of Pacer ETFs. Great seeing you, Sean.
Thanks, Tom. Good to see you as well.
You are a student of the market and also a student of advisors. What were the flows that we saw in 2019 telling us about how advisors were looking at the market?
Well, I think everybody's starting to get a little bit suspicious, if you will, a little tired of the bull market, a little anticipatory of what may be to come. We've had 11 straight years of a bull market run here. It's been really nice, and what advisors are telling us right now is that they're running into two types of clients: those who are invested in the market and wondering when they should get out, and those who have already taken their money out and are mad that they've missed it. And so we saw quite a bit of new flow last year at Pacer ETFs into our Trend Pilot series, which uses a simple 200-day moving average to determine exposure to an index. It's a way to stay invested in the market, and then if things change based on the rules that we use, at some point you'll go to the sidelines. So that was good for us.
So within that Trend Pilot series, both on the equity and the fixed income side, it keeps you in as long as you're above the 200-day average, and then internally within the ETF will go to a cash position if you go below, correct?
That's exactly right. But the whole idea being that you don't want to ride whatever market or whatever index you're tracking all the way to its eventual bottom whenever this bear market cycle comes.
And it's got the benefits, the tax efficiency benefits that an ETF has as well, where if you're doing that outside of the ETF, you're paying the capital gains,
yeah,
right?
The tax efficiency, obviously the wrapper is a big deal. The other thing that's really important that people miss though is once you get out of any asset class that you're tracking, if we trigger, it's usually a really bad event that causes that, and then people don't want to go back in. So the fact that it moves the money back in automatically is almost as big an advantage as a tax efficiency.
Getting over that emotional hurdle is key. And the other thing is, as an advisor and having that ticker symbol in there, because it is getting in and out of the market without changing that ticker. So it looks stable within the portfolio, but it's providing that hedge, correct?
That's exactly right.
Yeah.
So,
great, excellent. As always, great seeing you, Sean.
Thanks so much for having me today. I appreciate it.